I would like to welcome you to this class about price earnings to growth ratio. A multiple can be adjusted by its most important fundamental factor. The fundamental factors that have an impact on the level of the price to earnings ratio are the growth rate, the payout ratio of the earnings, and the expected return. So studies conclude now that the expected earnings growth rate has the highest impact on the PE ratio. So to calculate now a price multiple that includes the most important fundamental factor, which is the growth rate for the price to earnings ratio, we take the price multiple, so the price to earnings ratio, and we divide it by the growth rate times 100. So the PEG ratio reflects the PE ratio of the stock for 1 percentage point of expected earnings. The price multiple calculated in this way can be compared then with multiples of companies in the same industry. Equity securities with a low PEG ratio are attractive securities because they have a low PE ratio, so therefore they appear to be undervalued and they have a high growth rate. So that means in addition to have the value bias due to the low PE ratio, we also have a growth bias due to the high growth rate. Then as an indicator of an attractive equity security, a PEG ratio of 1 or less than 1 is often used in valuation practice. Why? Because the PE ratio is lower than the expected earnings growth rate multiplied by 100. Such an equity strategy is known then as growth at a reasonable price. The PEG ratio should be calculated with the trailing or with the current PE ratio. The trailing PE ratio takes into account the earnings then of the last 12 months. However, the PEG ratio should not be calculated with the forward PE ratio, otherwise the earnings for the next period are counted twice, which leads then to a PEG ratio that is too low. To demonstrate this, I can take the forward PE ratio and divide it then by the growth rate times 100. So I'm writing down the forward PE ratio, and the forward PE ratio, that's the current price divided by the current EPS times 1 plus the growth rate. And that is divided then by the growth rate times 100. So that means that the share price is divided by the earnings per share of the current period times 1 plus the growth rate times the growth rate times 100. And we see here that the growth rate is included twice in the denominator, and therefore if we take the forward or leading PE ratio, then we will obtain a PEG ratio which is too low. The PEG ratio should be calculated consistently and in the same way for all peer companies as well as for the company to be valued. Let's take the example on the next slide. Here we're looking at the Mercedes-Benz Group stock, and we perform a relative value analysis based on the comparables methods using the price multiple of price earnings to growth ratio. So for the automobile manufacturer subsector, the following global peer companies are given in order of market capitalization. So we found Tesla because of its negative trailing PE ratio. With the corresponding trailing PE ratios, expected annual earnings growth rates for the next 4 years, the PEG ratios, and the betas as at the end of October 2017. So we see here the trailing PE ratio. Then we see as well in this table the trailing PE ratio of Mercedes-Benz Group, which is 7.4. And we see as well that the median has a trailing PE ratio of 9.1. So the benchmark, the peer companies or the companies operating in the automobile industry have an average trailing PE ratio measured with the median of 9.1. Now, if you compare the trailing PE ratio of the Mercedes-Benz Group stock with that of the median of the industry, then we can conclude that the Mercedes-Benz Group stock appears to be undervalued. If we take the expected earnings growth rate of 3.8% of the Mercedes-Benz Group and we compare that to the median of 5.4% of the industry, then the relative low growth rate of the Mercedes-Benz Group compared to the average value of the industry does not justify the conclusion that the stock appears to be undervalued. So the low stock price is justified then by the lower growth rate. Now we have to answer the following question: is the Mercedes-Benz Group stock correctly valued based on the comparables method using the PEG ratio? So far I've just used for this relative value analysis that I did before the price to earnings ratio, and now let's take the PEG ratio. To perform the relative value analysis with the PEG ratio, we take the PEG ratio of the industry of 1.7 and we multiply it with the earnings growth rate of the Mercedes-Benz Group stock times 100 to get then an adjusted PE ratio of the Mercedes-Benz Group stock that we can compare then afterwards with the PE ratio of the Mercedes-Benz Group stock to determine then whether the Mercedes-Benz Group stock is correctly valued in the market. So we calculate first the adjusted PE ratio of the Mercedes-Benz Group stock. So the growth adjusted PE ratio of the stock, that's of the Mercedes-Benz Group stock. That's calculated as follows. We take the PEG ratio of the industry, the automobile industry, of 1.7, and we multiply that by the earnings growth rate of the Mercedes-Benz Group, which is 3.8%, so written in decimals 0.038 multiplied by 100. In doing so, we will get then a growth adjusted PE ratio of the stock of 6.5. So why do we obtain the price to earnings ratio? So we start with the PEG ratio of 1.7. The PEG ratio, that's the trailing PE ratio divided by the growth rate times 100. And then we multiply that by the growth rate of the stock times 100. So you see that the growth rate times 100 cancels out and we will be left then with the price to earnings ratio. So that's then the growth adjusted trailing PE ratio of the Mercedes-Benz Group stock, which is 6.5. And next we can compare the growth adjusted PE ratio of the stock calculated above. So the growth adjusted PE ratio of the stock calculated above of 6.5, and we can compare that with the trailing PE ratio of the Mercedes-Benz Group stock. So if you go back to the table, then we see that the Mercedes-Benz Group stock has a trailing PE ratio of 7.4, and that means that the stock does not anymore appear to be undervalued, but now overvalued, because the growth adjusted PE ratio of the stock is lower than the PE of the stock. And that obviously indicates that the stock appears to be overvalued. However, this conclusion that the stock appears to be overvalued applies only if all equity securities have the same risk. Moreover, this analysis assumes a linear relationship between the PE ratio and the expected earnings growth rate. After we have applied the methods of comparables, let's now have a look at the justified PEG ratio. And the PEG ratio based on a one-stage dividend discount model can be determined as follows. We take 1 minus the earnings retention rate times 1 plus the growth rate divided by the growth rate times 100 times the difference between the expected return and the growth rate. And now let's have a look how we can determine the PEG ratio from the one-stage dividend discount model. So to demonstrate that, I'm writing down first the price equation using the one-stage dividend discount model. So the intrinsic share value equals the dividend per share multiplied by 1 plus the growth rate divided by the expected return minus the growth rate. And now we can replace the current dividend per share with the earnings per share multiplied by the payout ratio of the earnings. And the payout ratio of the earnings, that's the same as 1 minus the retention rate of the earnings. So here I use the variable b for the retention rate of the earnings. So b, that's then the retention rate. And now we can replace in the one-stage dividend discount model the current dividend per share with the earnings per share multiplied by 1 minus the earnings retention rate. In doing so, we will get then the following equation for the intrinsic share value. So that's then the current EPS multiplied by 1 minus the earnings retention rate times 1 plus the growth rate divided by the expected return minus the growth rate. And now next we can divide both sides of the equal signs by the current earnings per share. In doing so, we will get then to the left of the equal signs the trailing PE ratio, and to the right of the equal signs the current EPS cancels out. And next we can divide both sides of the equal signs by the growth rate times 100. So divided by the growth rate times 100. In doing so, we'll get then the PEG ratio. So that's the trailing PE ratio divided by the growth rate times 100. That equals then 1 minus the earnings retention rate times 1 plus the growth rate divided by the growth rate times 100 times the expected return minus the growth rate. If we take now a closer look at the justified PEG ratio, so that's the justified PEG ratio, then we have to understand that a negative PEG ratio does make no economic sense, and therefore the expected return must be higher than the growth rate. Then we see as well that there is a positive relationship of the PEG ratio with the earnings payout ratio. So a higher earnings payout ratio results then in a higher PEG ratio and vice versa, while the relationship with the expected return or risk measured with the beta of the stock is negative. So a higher return expectation results then in a lower PEG ratio. So these are the fundamental factors that have an impact then on the level of the PEC ratio. Let's take now the following example to calculate the justified price earnings to growth ratio using the Deutsche Telekom stock. The following information is available for the listed Deutsche Telekom stock at the beginning of 2022. So we know about the dividend per share for the period just ended, that's for the year 2021, 0.64 euros. Then we know the earnings per share for the year 2021, so that is 0.87 euros. The traded share price at the beginning of 2022 is 16.55 euros, and historical beta of the stock is 0.7. The company is assumed to grow in perpetuity based on its 2021 fundamentals, so we have to use then afterwards the payout ratio and the return on equity to calculate then the fundamental growth rate. The return on equity is then 10.6% that we can use to calculate the fundamental growth rate, and as the risk-free rate, the yield to maturity of 30-year bonds of the Federal Republic of Germany is given, which is 1.1%. and the expected market risk premium for Germany is 7%. Now, what is the justified PEC ratio of the Deutsche Telekom stock, and is the stock correctly valued based on the PEC ratio? To calculate the justified PEC ratio, so justified by the one-stage dividend discount model, we can take 1 minus the earnings retention rate multiplied by 1 plus the growth rate, and that's divided then by the growth rate times 100 times the expected return of the shareholders minus the growth rate. And now let's calculate first 1 minus the retention rate of the earnings, so that's the payout ratio. So we calculate first the payout ratio, and the payout ratio is calculated as follows. So we take the dividend per share, and the dividend per share in our example is 0.64 euros, and we divide that by the earnings per share of 0.87 euros. If we calculate now the payout ratio, then we obtain a payout ratio which is 0.7356. That can be included in the above equation for 1 minus the retention rate of the earnings. That's then the payout ratio, so 0.7356. Then next we can calculate the growth rate. To calculate the fundamental growth rate, we take 1 minus the payout ratio, and we multiply that by the return on equity, which is 10.6%. And if you're entering the figures in your calculator, you should get then earnings growth rate of 2.8%. So we can include in the above equation the growth rate. So we take then the payout ratio of 0.7356 multiplied by 1 plus the growth rate, so that's 1.028, divided by the growth rate of 0.028 times 100 times the difference between the expected return and the growth rate of 0.028. Then next we have to calculate the expected return. The expected return can be calculated using the capital asset pricing model. So we take the long-term risk-free rate, which is the yield to maturity of the 30-year bond of the Federal Republic of Germany. So that's 1.1%. plus the expected market risk premium for Germany, so that's 7%, and we multiply that by the adjusted beta, so by the beta adjusted then for mean reversion. So to calculate now the adjusted beta, we can take the following equation, so 0.333 plus 0.667, and we can multiply that by the historical beta of 0.7, and that gives then the adjusted beta of 0.8 that we can include above in the CAPM return equation to calculate then the expected return. So we get then an expected return of 6.7% that we can include in the justified PEC ratio, so 0.067. And if you're entering the figures in your calculator, you should obtain then for the justified PEC ratio 6.92. And now we can compare the justified PEC ratio calculated above with the PEC ratio of the stock in the market, so the PEC ratio of the stock. So we have a justified PEC ratio 6.92, and the PEC ratio of the stock can be calculated as follows. So we can take the traded share price. The traded share price is 16.55 euros and divide that by the earnings per share of 0.87 euros. In doing so, we'll get then the trailing PE ratio that we can divide then by the fundamental growth rate of 2.8% times 100. So let's do that. So we take the traded share price of 16.55 euros and we divide that by the earnings per share of 0.87 euros, and that's divided then by the growth rate, which is 2.8%, so 0.028 times 100. And if you're entering the figures in your calculator, you should obtain then for the PEC ratio 6.79. And now we can compare the PEC ratio of the stock in the market of 6.79 with the justified PEC ratio, which is 6.92, and we see that the justified PEC ratio is higher than the PEC ratio of the stock in the market, so indicating that the stock price is too low and therefore the stock appears to be undervalued. So we can conclude that the stock appears to be undervalued based on the PEC ratio.